I don't usually do this because I don't like to say this stock is going up and it's going to the moon, rocket ship emojis, whatever. It's just not my style. But I'm going to be doing that today because I do think that this stock is going up and you don't want to miss this rocket ship to the moon. If you haven't watched my video on Upstart, then make sure you do that. I'm going to try to link it here using those YouTube thumbnails. If not, it'll be in the description. And you should watch that before you watch this video because it'll give you some more insight as to this business model, which I'm going to refer to today. Hey everyone, my name is Bill Hawk, and in this channel I talk about stocks, crypto, real estate, anything related to business and investments. It's just something I'm passionate about and something I do full time, so that's where I'm trying to share my knowledge and share my journey with you guys. At any point in this video, if you receive some value, please hit the like button and subscribe because it helps me out with the YouTube algorithm and it helps me keep going doing these videos because this is something new for me. So I really appreciate it. Let's get down to the video. From this point in the video, I'm going to assume that you understand the Upstart business model, or you watched my video on Upstart, which would help you do that, of course. Which, by the way, the stock went parabolic since I posted my video. It did decline recently, so I was able to start my position. But if it declines a little bit more, I'm going to add to it because it's still an expensive stock. So what if I told you that there was a stock which had a better risk-reward ratio, a better alternative, Lending Club? Lending Club and Upstart pretty much have the same business model. Lending Club did, however, start off as a peer-to-peer lending platform, but they changed that this year after their acquisition with Radius Bank, and now they're pretty much the same identical model as Upstart. I honestly think that Lending Club just came public too early and their IPO was at the wrong time, but I think they're going to turn this around right now with their new business model, and the momentum is really strong, especially when you look at the trajectory of Upstart. I think they can piggyback off of it. Their business models pretty much come down to one thing, which is loan origination. Loan origination, according to Wikipedia, is the process by which a borrower applies for a new loan and the lender processes that application. Origination generally includes all the steps from taking a loan application up to dispersal of funds. The key difference between Upstart and Lending Club's business models is that Upstart sells all the loans it originates mainly to two key banking partners, whereas Lending Club, it has a banking charter itself. So it retains about 20% of the loans it originates and keeps it on its balance sheet and services them. And also remember I said they had a peer-to-peer lending platform. Well, they basically converted that into a high yield savings account for retail investors who still want to participate. So Lending Club, in short, has a much more diversified business model and it's just a winner in this category for me. The argument for Upstart is that they have an AI-powered lending algorithm which takes 1,000 data points and supposedly superior to FICO or anything we've seen before, allowing them to generate more loans with less risk. But again, this is something proprietary, so we don't know what's behind the curtains or what they're doing differently from Lending Club. But Lending Club, we do know, is actually using AI-driven models as well. They're just not plastering it all over their marketing. Upstart is just doing a much better job marketing the fact that they have these AI-driven models. And Lending Club, although they're using it, they're probably not using it as much as Upstart. So Upstart is generating 70% of their loans completely automated, which is what they say. But in the case of Lending Club, it's probably not that high and they're probably just being more prudent. But it doesn't mean they don't have enough data. You can't discount Lending Club because they have 15 years of experience and also generated over $60 billion in loans. I just want to read part of their Q1 2021 earnings transcript where CEO Scott Sanborn talks about this, so you know I'm not just making it up. He says, we take this huge data set and apply referring to their $60 billion in loan origination, and apply the latest analytical techniques, including neural networks and machine learning to inform our decisions. We deployed dozens of models to drive our targeting, fraud, underwriting, pricing, servicing, and user experience, and to manage outcomes for distinct customer segments. This allows us to make compelling offers to customers while providing competitive returns for platform investors. It also allows us to automate originations and efficiently grow loan volume without proportional increase in headcount. So it's pretty much the same thing as Upstart, but Upstart understandably just has a better sex appeal. But Lending Club might be the one you want to end up owning. So let's take a look at the numbers because at the end of the day, they don't lie. If you want access to this spreadsheet, then sign up to my newsletter. The link is in the description. And that way you have access to play around with the numbers, assumptions, and make your own model, which should give you more conviction should you make this investment. But of course, I don't blame you if you don't want to do that because it's much easier to just watch me go through mine. So to start things off, let's take a look at Lending Club's revenue. So I'm expecting them to have about 2.6 billion in revenue by 2024, which is a 46% compounded annual growth rate, which of course is pretty high. But when we look at Upstart's, I think they're going to do about 4 billion in revenue by 2024 at a much higher compounded annual growth rate. But we can't just take this and run with it. We have to take it with a grain of salt because there's a lot of risk and uncertainty with Upstart's model, and there's also limited history. In terms of loan origination, you can see they're both making about 7% of total loan originated volume. So for the year 2021, I'm expecting Upstart to generate about $10 billion in loans, of which they make about 7%. And you can see for Lending Club, it's about the same. They're a little higher, I'm expecting, and you can see it's about 10 billion. So they're along the same lines in terms of volume. The real kicker, however, is net income and net income margin. So as you can see here, for Lending Club, their net income margin has been increasing, but it's at about 5%, 11%. I'm expecting them to be about 2% for the year, which is pretty low. But when we take a look at Upstart's, so let's take a look at their actuals. You can see in the last quarter, they were actually at about 19%. So they have a much higher margin. I'm forecasting them to be about 10% margin to be conservative and 12% and going up to 15% going forward. So that's obviously much higher than Lending Club, which we can see here. But Lending Clubs is improving, and it's a little bit misleading now because of what I'm going to get into. So Lending Club is required to comply with current expected credit loss or CECL provisions, where it wrote off 34 million in the last quarter and it deferred 17.5 million of revenue as well. So if we add that back here, so over here in the last quarter, let's add that back just to give you some perspective of this credit loss provision. So that's 34 million and 17.5 for the deferred revenue. They're at a 32% net income margin. Now we're talking a higher margin than Upstart. Of course, you can make the argument that what if these losses occur, then of course Lending Club's margin is going to decrease. And yes, that's a valid argument, but generally companies are more conservative with this approach. But if we measure them apples to apples, my point being Lending Club and Upstart should have a similar valuation. Before we answer that, I want to point out that Upstart is spending about 40 to 50% on marketing to acquire the origination of those loans. Not to mention, a lot of their marketing is concentrated on just a few sources. Lending Club, on the other hand, kicked it up in the last quarter and went up 30%, which is significantly lower than Upstart. I do think that Lending Club, yes, should spend on marketing to gain that market share and grow faster and solidify themselves as the #1 competitor in the space. But what I'm trying to point out here is that Lending Club is just more efficient than Upstart at acquiring those leads, and they're able to do it organically, possibly because they've just been around longer. Lending Club has a market cap of 4.5 billion, whereas Upstart has a market cap of 26 billion. So that's 6 times more than Lending Club. I'm not saying Upstart is a bad company. I'm just saying that Lending Club is hugely undervalued and they deserve more recognition. And I do think that they should be valued at about the same multiple. So going back to valuation, if Lending Club trades at a 40 times multiple of earnings in 2024, they should be at $130 a share. So that's my target, and that's almost a 2x from here, which I think is very doable and it should happen. So Upstart, let's give them, as if you watch my video, you already know this, a 50 times multiple of earnings on 2024. They should be at 380 bucks, which is about an 18% upside from where they are right now. The writing is on the wall. I'm not saying that Upstart is a bad stock. In fact, I actually bought some. I started my position in it, and I think it's a good place to enter. It's a calculated gamble at the very least, because think about it. Lending Club just had a blowout quarter and they blew past their earnings estimate. I think Upstart might do the same. I know that's a big assumption. They're two different companies that run completely differently, but let's just say they do. On November 9th, I think when they report the earnings, that stock is also gonna pop. But when it comes to risk-reward ratio, it's very clear. Lending Club is the winner by far. And I just wanna bang on the table and say that this stock should 2x. I'm buying it even here after it's gone up 30%. I think it has a long way to go. It just doesn't have the recognition it deserves. There's not that many analysts covering it, but I am, and I'm telling you that this stock is definitely trading below its worth, especially if you compare it to Upstart. And like I said, I think this industry has a lot of headwinds. It's gonna, headwinds or tailwinds, I don't know, whatever winds it is, to basically make this stock go higher. But yeah, that's pretty much it. So I'm gonna be buying this stock. Of course, do your own research, do your own due diligence. There's a lot of risk investing in a lower market cap stock like Lending Club, but I think that the risk reward is worth it. So if you have any feedback for me on this video, I really appreciate it. Leave them in the comments, like, subscribe to my newsletter. Let me know what you think of the video. I'm just new to YouTube, and I think that I can share my journey and hopefully provide some value to you. So I hope you enjoyed it, and I will see you on the next one.